Well, it couldn't have come at a more opportune time. The opportunity to talk to the top think tank at Kotak Mutual Fund and Nilesh Shah, Harsha Upadhyaya with us right now as they release their FY27 outlook. And interesting times to do this because we are all hoping for a few things to happen on the global front for India. The rupee is depreciating quite significantly and equity markets have consolidated for a long time. What happens in FY27? Either of you can start. Nilesh bhai, maybe start with you.
So we are more optimistic about CY26, FY27. Global growth will slow down, but there will be fiscal stimulus across the world. Monetary policy will take a step back with lesser number of rate cuts in CY26 over CY25. From Indian point of view, the growth will slow down a little bit, but corporate earnings growth will recover from low single digit or mid single digit to low double digit. FPIs have been net sellers in CY25, but we believe they will become net buyers in CY26 as earnings growth recover, our valuation comes around to our historical averages, and more importantly, they are underweight India. Most importantly, we'll have to moderate return expectations. People still think 20% return is their birthright. Well, that was possible when inflation was in double digit. Now inflation is in low single digit. There's no way that kind of return be possible.
Harsha, so is the earnings growth the necessary and the sufficient condition for the market's recovery, or essentially growth is the sufficient condition, or do other things need to fall into place, which is that FPI flows need to return and thereby maybe the trade deal needs to happen, thereby maybe global stability needs to happen? What do you think drives equity returns in FY27 or calendar year 26?
I would say it's definitely a necessary parameter to look at. While markets are also driven by flows and sentiments, fundamentals do matter. And we are going to see a recovery in second half of this financial year as we speak in terms of earnings growth. And we should expect that to continue into financial year 27 as well. So that's the expectation, that the tepid growth that you have seen in terms of earnings growth for last several quarters should improve into double digits going forward for the next few quarters. And along with that, if
starting quarter 3, you reckon, or
yes,
maybe
starting quarter.
Okay, yeah, please.
And sequentially, it should improve as well. And along with that, if you also have support from sentiments and flows, that will be even better for the markets. But that we cannot predict at this point of time. But from a fundamental perspective, definitely things are improving over the next few quarters.
There is a lot of ponderables, Nilesh bhai, around the rupee and what the rupee is doing. I was talking to Chetan Haya in the morning, and he said that the Morgan Stanley global team believes that calendar year 26 first half, the dollar may depreciate against all Asian and emerging market currencies, and that is a normal tailwind. But I remember we having a conversation that the yuan depreciating, rupee depreciating, all of the currencies are moving in tandem. November has been quite the opposite, right, in that sense. So the rupee is maybe getting singled out as well. Do you think that the pace of deceleration might ebb a little bit, or will we still see some more downsides for the currency?
So we still believe destiny of rupee is to depreciate.
Our
inflation and our productivity continues to remain at an adverse position to our partners. Hence, to maintain our export competitiveness, rupee has to depreciate. Now, rupee is not a straight line depreciation. It moves like a pendulum. But I think rupee will continue to depreciate 2 to 4% every year.
The recent swiftness with though it has happened, and a lot of people attributing this primarily to the FPI outflows, not necessarily to macros. Does that stop a bit? I mean, the policy therefore becomes so important. Any thoughts?
The currency is driven by flows as well as fundamentals. On a fundamental basis, our real effective exchange rate was much higher. And now flows are pushing rupee to go to that level. The FPI outflow, the trade deficit, both are contributing in terms of outflows. And more importantly, our fundamental, the real effective exchange rate was on the higher side where rupee is going.
Okay. So then, and the question to you and then the same question to us.
ऐसा कह सकते हैं नीरज भाई कि देर आए दुरुस्त आए. Someday we have to reach our fundamental value.
Okay. And is this close to the fundamental value, Nilesh bhai, or is it difficult to call?
Probably still 1 to 2% lower.
Okay, fine. And therefore, the subsequent question, Harsha, in light of the rupee being such a key sentiment driver, if you will, are we looking at slightly sluggish scenario until earnings come to the fore, assuming that the trade deal doesn't happen? If the trade deal were to happen, then that's of course the other big trigger. But in the absence of that, because of the currency-driven sentiment, do markets stay tepid until earnings come to the fore?
Currency is an important parameter for foreign institutional investors, not so much for domestic investors.
Agreed.
So to that extent, the kind of flows that we are seeing on the domestic side should continue irrespective of where the rupee dollar rate is. But yes, for foreign institutional investors, they always look at the fundamental growth in an economy and also how much more can they make on the currency or how much they are going to lose on currency. So to that extent, it's going to be an important parameter for them. So yes, they will consider and take their decisions. But I think from a medium to long-term perspective, things are turning out better for India from a global perspective. For example, last year, the average earnings growth for Indian equities was lower than that of emerging markets, for example. Plus our valuations, which have always been at a premium to emerging markets, was at a really high level. Right? So that's when we have seen our markets underperforming some of the other markets by 30, 40 or even higher percentage in the last 12 months. Now that those markets have outperformed us in a significant way, their valuations have also moved up. So our valuation premium has narrowed. It's not very, very small premium now, but it's at an average premium. So to that extent, it's kind of moderated quite a bit. And we are likely to see earnings growth picking up. So that is also helping us. So given all of this, rupee dollar rate may not be the only parameter that they will look at when they are investing into our country. We are still hopeful of the flows turning positive from foreign institutional investors in the next calendar year.
Have I read this correct that you guys believe that mid caps and small caps would outperform in FY27?
No, not exactly. What we are saying is you will see earnings recovery in the market. Large caps would probably go to low double digits in terms of earnings growth. Mid caps will do slightly better than large caps. However, the small caps, which have been disappointing in terms of earnings growth in the last couple of quarters, may continue to remain that way. Plus, the valuation premium on small caps vis-a-vis their own historical average is also much higher. So that's where we are not so positive on the small cap segment, but we do believe that mid caps can outperform large caps, but the outperformance may not be very large because the differential earnings growth is not very large, and plus mid caps themselves are also trading at slight premium to their historical average.
Got it.
By and large, in terms of preference, mid, large and small is what votes.
Mid, large and small. Okay, and just before I get to a macro question with you, Nilesh bhai, Harsha, just a follow-up there. Thematically, sectorally, what is it that you think does well? Because sector rotation would be the order of the day. You would be looking at various factors. What is in store for calendar year 26?
We believe that banking and financial services, which have already started to outperform in the last couple of quarters, will continue that trend into next year. I think broadly the margins should remain stable. We are not expecting too much of repo rate cuts from here on. We do expect growth to pick up on the credit side, and the asset quality issues are not there, and the valuations have been reasonable in the overall context of the market. So that's one segment where we believe things will be better in calendar year 26. Okay. The consumption, especially the discretionary consumption, is something which has got a policy push from various sides over the last several quarters, and the last one was, of course, the GST rejig. Right, and that's where we believe that there is room for a further growth and a structural growth in terms of consumption, and that should play out differently in different segments. But broadly, discretionary consumption should do better than the staples consumption, because you are unlikely to see higher volumes there. Other than that, we are also positive on healthcare opportunities, where we believe that while the pharmaceuticals will continue their dominance in terms of global markets as well as Indian markets, the hospital segment is the segment to watch out for, given that our population is aging, and because of the lifestyle changes, there are more diseases that's coming in. And also, given the per capita increase in income, you will see more healthcare investments to happen and opportunities to come up.
Got it. And I believe rural side you guys are constructive too, because I believe there was an NFO to that effect as well. Okay, so that's interesting. Nilesh bhai, macro events that one should watch out for. I believe you guys have mentioned that the prospects of India entering the Bloomberg Global Aggregate Index are strong. That plus the different FTAs that India is signing. Vladimir Putin's visit to India as well in the next couple of days. What are the macros that you watch out for, aside of course, the much hyped about US-India trade deal?
So one event which we will be watching out for is budget. There is a commitment on fiscal prudence side, not only in terms of deficit but also debt to GDP ratio. On other side, there is provision for 8th pay commission. Now the commission has just been established. It will take time to submit a proposal, but should the budget provide for that? Now if that's provided in this FY27 budget, it's likely to have much larger deficit than what was promised. That means we have to mobilize additional resources. Now if you look at India, whenever stock market goes up, the wealth effect is visible in real estate, it's visible in consumption. A much bigger wealth has been created for common citizens through gold and silver appreciation. But that wealth effect is not visible in consumption or real estate. Partly because that gold and silver is lying in Tijori in parallel economy. Can the budget think out of box, bring that gold and silver out of Tijori into the main economy? It will raise revenue for the government. It will put money in the pockets of consumers. They can invest, they can spend, and the whole economy can get a boost. So I hope budget does out of box thinking in defreezing gold and silver, maintaining fiscal prudence, and yet providing for 8th pay commission.
Okay. In some sense, Nilesh bhai, I want to end this conversation by talking about from geopolitical perspective, what is the most important thing? I mean, 2025, everybody probably believed that Donald Trump's moves might be the one to watch out for. He's not disappointed on that front. His moves are being watched out for. But is that still a very important factor, or are there other factors that you're watching out for?
Undoubtedly, geopolitical is becoming challenging, and India has been unfairly targeted by US, even though we are not the largest buyer of Russian energy. China and EU does it. We honor American sanctions on both Iran and Myanmar. China routinely sidesteps that, and yet America is in bed with China and keeping India afar. More importantly, the one event which we will be watching out, will investors take money out of America? They own about $30 trillion worth of assets. With dollar coming down 10%, they have suffered $3 trillion of loss. That's partly compensated by equity rally in American market. But there are worries on whether AI investments will give returns or not. Second, President Trump's policy is also creating uncertainty. If money starts moving out of America, India could be beneficiary as some of those flows will come to India. So apart from President Trump's policies, we'll also be watching if global investors take money out of America.
Yeah, that's such an important thing. Last two questions to both of you each. Harsha, to you. You get tempted to do more on the global front while you're managing Indian money. So many people talking about distributing investments, looking at the global markets. Do you get tempted to do that too?
We do
for
have
calendar year 26.
We do have certain products which invest into overseas markets, but those products will do that job. But the rest of the products, we will focus on India and where we have our strengths.
Right.
I think there is still money to be made and a decent amount of money to be made in Indian equities. We will focus on that as well.
So even if 2026 is not a banner year, Harsha, you believe decent equity returns possible to be made with moderated return expectations?
Yes, that's right. It should improve compared to 2025, and simply because the earnings are expected to improve and the valuations have also moderated compared to where we were 12 months back. So I think things are falling in place now.
Okay. Last question, and can't end without a cricket analogy. I wonder if he does that in the meetings as well, when he talks about cricket to tell you guys XYZ things. Does that happen?
Sure.
It happens? Okay, Nilesh bhai, let's end with a cricket analogy. I don't know if Harsha also wants to chime in with that, but yeah.
So, form is temporary, class is permanent. Very recently, Virat Kohli showed in that first one day against South Africa. Indian market bhi Virat Kohli hai. there could be a lean phase, but finally class is permanent.
Okay, you want to respond to that?
No, I'm not going to compete with him on that.
I don't think anybody can do that, to be very honest. So I don't mind that. But thank you so much, both of you. Lovely note, by the way. I read your note before I came in, so lovely note as well. And all the best for calendar year 26 rather, to all of us.
Thank you.
Thank you.
Thank you. And viewers, thanks for tuning in.